Two funds, same underlying index. One pays you 12% a year, the other pays 7. Over 5 years, the one paying 7 made you significantly more money. That is not a paradox and it is not bad luck. It is a direct, predictable consequence of one decision the fund manager makes. And once you understand that decision, you can look at any covered call fund and know roughly what you are actually buying. Before we begin, the disclaimer, I am not a financial advisor and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing is a recommendation to buy or sell anything. Investing involves risk, including the loss of your capital. Past performance does not guarantee future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. And welcome to the channel. Here we go deep. We don't do surface level tips or hot stock picks. We break down the real mechanics that move markets and the money inside them. Today, covered call ETFs, an $80 billion corner of the market, and the one tiny setting, the strike price that decides whether you get rich income or slowly bleed. Covered call ETFs have exploded from a niche idea into one of the fastest growing corners of the market. With combined assets now past $80 billion, they promise monthly income in the high single digits to low double digits. But two funds using the same basic idea can end up worlds apart, one quietly compounding, the other slowly eroding. The difference comes down to a few mechanical choices most investors never look at. Let us open the hood. Start with the basic trade. A covered call has two parts. The fund owns a basket of stocks, then it sells call options on that basket. A call option gives the buyer the right to buy those stocks at a fixed price, called the strike, before a certain date. For granting that right, the buyer pays the fund a premium, upfront cash. That premium is the income the fund distributes to you. So far, it sounds like free money. It is not. You are selling something real in exchange. Here is what you sell. If the stocks stay flat or fall, the option expires worthless, the fund keeps the premium and the shares, and everyone is happy. But if the stocks rip higher past the strike price, the buyer exercises their right. The fund must hand over the gains above the strike. You keep your premium, but you miss the breakout. So a covered call trades away your future upside in exchange for income today. In a flat market, that upside was not coming anyway. In a roaring bull market, you get left behind. Now, the single most important variable, the one this whole video is named after, where you set the strike price. This one choice decides how much income you collect and how much upside you keep. There are two main approaches, and they produce completely different funds. At the money and out of the money. Understand these two, and you understand the entire covered call universe. First, at the money or ATM. Here, the fund sells call options with a strike right at the current price of the stocks. Because the option is right on top of the price, it is the most valuable to the buyer, so the fund collects the biggest possible premium. That means the highest yield, often 11 to 13%. But there is almost no room for the stocks to rise before the strike caps them. You get maximum income and almost zero upside. The most prominent at the money fund writes 1 month calls on the entire NASDAQ 100. And here is the price of that maximum income. The most famous at the money fund has badly trailed its own index over any extended period. Over the 5 years through early 2026, it returned roughly 7% annualized, while the NASDAQ 100 it tracks returned around 17. Its net asset value eroded by an average of nearly 4% every single year. That is the at-the-money trade laid bare, a huge headline yield and a total return less than half of simply owning the index. But why does the net asset value actually shrink? Because the strategy is asymmetric in a way that compounds against you. When the index rises sharply, your shares get called away at the strike price. You keep the premium, but you hand over the gain above it. When the index falls, nobody exercises anything. You keep the shares and you take the full loss, cushioned only by whatever premium you collected. So you systematically surrender your biggest up months while absorbing your down months almost completely. Repeat that through a few market cycles, and the base your income is calculated on gets smaller. That is why an eroding fund can advertise a stable percentage yield while the actual cash it pays you quietly shrinks. The percentage holds, the base it applies to does not. Now, the second approach, out of the money or OTM. Here, the fund sells calls with a strike set above the current price. The option is worth less to the buyer, so the fund collects a smaller premium, which means a lower yield, often 7 to 8%. But crucially, it leaves a gap. The stocks can rise up to that higher strike before the cap kicks in, so you sacrifice some income to keep some of the upside. In a rising market, this difference compounds enormously over the years. Picture a month where the index rises 5%. The At the Money Fund captures almost none of that. Its strike was right at the start. An Out of the Money Fund might capture a few percent of the move plus its premium. 1 month the gap is small. But repeat that over years of a generally rising market, and the out of the money approach pulls dramatically ahead on total return, even though its headline yield looked smaller on day one. The bigger yield is not the bigger return. And there is a second variable, one that almost nobody mentions, which decides how much income exists to be collected in the first place. Option premiums are priced on expected volatility. When markets are calm and volatility is low, options are cheap, so the fund collects less and the distribution has to shrink or come from somewhere else. When markets are turbulent, premiums are rich and the income looks fantastic precisely when the underlying shares are falling. So the yield on a covered call fund is not a stable property of the fund at all. It is a reading of how frightened the market currently is. A quiet year and a violent year produce completely different income from exactly the same strategy, and neither tells you anything about whether you are actually making money. Now, a structural twist that matters a lot for the most popular funds. Some of the biggest covered call ETFs do not sell options directly at all. Instead, they hold a basket of defensive stocks plus something called equity linked notes, or ELNs. An ELN is a custom contract bought from a big bank that is engineered to behave like an out of the money covered call. The bank does the option writing. The fund just holds the note and collects the income. This gives the managers more flexibility, but it introduces a new subtle risk. That new risk is counterparty risk. An equity-linked note is a private contract with a specific bank. If that bank ran into serious financial trouble, the income stream from the note could be disrupted. It is a low probability risk, but it is a real one, and it is the price of the flexibility. Funds that sell exchange-traded index options directly, rather than using banknotes, avoid this particular risk entirely. It is a genuine trade-off, not a free lunch. There is also a tax dimension that quietly changes your real return, and it differs by structure. Income from equity-linked notes is generally taxed as ordinary income, the highest rate bucket. For someone in a high tax bracket, an 8.5% yield can drop to under 6% after federal tax alone. Funds built on certain index options can receive more favorable tax treatment. The practical takeaway, the structure that is best for you can depend heavily on whether you hold it in a taxable account or a retirement account. Which brings us to the question you should ask of any high distribution, and it applies to every fund in this category. What is the money actually made of? A distribution can be option premium, the fund genuinely earned. It can be dividends from the underlying shares, or it can be return of capital, which means the fund is handing you back your own money. All three land in your account looking identical. Only one of them is income the strategy produced. Funds publish a breakdown of what each distribution consisted of, and if a meaningful and growing share is return of capital, the headline yield is partly an illusion, and the eroding value is the receipt. One more thing every covered call investor must internalize. In a real bear market, these funds do not protect you. The premium income provides only a thin cushion. In a 30% index decline, a covered call ETF falls right alongside the index, cushioned by just a few percent of premium. They are an income strategy, not a downside hedge. Anyone who buys them expecting protection in a crash has misunderstood the product. So, who is each type actually for? An at the money maximum yield fund suits someone who needs the highest possible cash today, accepts that their capital will slowly erode, and ideally holds it in a tax advantaged account. An out of the money or ELN based fund suits someone who wants strong income but still cares about total return and keeping some growth. And in a strong, prolonged bull market, a plain, low cost index fund beats all of them. There is no best fund, only the right fit for a clearly defined goal. So the checklist, and this takes about 10 minutes. 1. Find the strike policy, at the money or out of the money, and by how much. That single fact predicts most of the behavior. 2. Compare 5-year total return, price plus distributions, against simply owning the index. If it trails badly, you paid for income with growth. 3. Look at the net asset value over 5 years. Flat or rising is healthy. A steady decline is the erosion visible. 4. Read the distribution breakdown for return of capital. 5. If it uses equity-linked notes, find out who the counterparties are. And 6. Check the tax treatment where you actually live because it can change the ranking entirely. To wrap up, covered call funds are not good or bad, they are a trade, and the strike decides the terms. At the money buys the largest headline yield and pays for it with growth and eroding value. Out of the money keeps more of the upside and pays a smaller, more sustainable income. Equity linked notes deliver the exposure through a contract with a bank, which adds counterparty risk and usually changes the tax treatment. Judge all three on total return after tax, never on the headline yield. None of this is a recommendation about any specific fund. That is for you to research. If this finally made covered call funds make sense, do me one small favor. Tap like. It genuinely helps more investors find this. Share it with someone who bought one purely for the yield. And subscribe because we do this properly every week. We do the digging so you do not have to guess. See you in the next one.